Welcome back to Multifamily Mentor Season 3. I'm your host, Terrance Doyle. No, wait. I'm Yonah Weiss.
I'm Terrance Doyle.
Oh, okay. We got Terrance Doyle here on the show, but I'm going to be your host today because apparently my episode from Season 2 was the most watched episode of Season 2 when we talked about cost segregation studies. Go and check out that episode. 2 parts over here. But I'm Yonah Weiss, the Cost Seg King, and I'm excited to be back with Terrance, the Value Add Dad. How you doing?
I'm doing amazing, Yonah, and I'm super excited to be sitting here interviewed by you, and you are the people's champ from Season 2, and so it's only fitting that you are the host, and so we're really excited to be here and talk about all things multifamily. We got some surprises at the end. You're going to talk about maybe a pivot for the Cost Seg King, going into maybe another aspect of multifamily, so stay tuned for that. I was surprised, you know what I mean? So I think that people are going to love that, but it's good. Interesting times. We're in really interesting times right now. Very challenging, choppy waters. But whenever there's challenge, there's incredible opportunity. So I'm extremely fired up and excited about the season that we're in terms of the economic environment and the opportunities out there. So super pumped to be here, talk about it, and hopefully share some knowledge.
Yeah, I mean, there's a lot of crazy stuff that's been happening in the environment in terms of mortgage rates going up, inflation, recession, all these kinds of talks have been going on for the past 9 months or so, almost ad nauseum. It's been a lot. Everyone has an opinion,
yeah, right?
But we're still doing deals, right? We still gotta have a business, multifamily investing, and we're still doing deals. So I'd love for you to talk about what are some of the deals that you're doing right now and some of the changes that you've seen in the market.
Yeah, great. So, what we're seeing is there's 3 key ways to finance deals right now. Bank financing in my mind is out, right? I even think agency financing is out. It's very difficult, right? Interest rates are up, proceeds are down, so returns are down, right? So that's kind of a thing of the past. The 3 ways that we're seeing, the number 1 way is seller financing. If you don't understand seller financing, go figure it out. Google it, check it out. We're going to have other episodes this season specifically on seller financing. I think it's the number 1 way to do deals, seller financing. Number 2 is cash, right? If you have cash. Right? Cash is king. You're going to be able to dictate terms. However, the return will be a little less than seller financing, right? Mm-hmm. And number 3 is a loan assumption, right? Loan assumptions still work. Anybody that has an agency or CMBS loan, or there's some other options from 2019, 20, 21, great way to do deals. My 3rd favorite right now is a loan assumption, but get really comfortable with seller financing, creative financing, understand how to negotiate that, get really comfortable telling brokers about that, because I think that's the number 1 way to do deals. And number 2 is cash. Lower return, not going to be as good of a bang on your cost seg, on the ratio there, but still a great way to dictate terms and to get deals done right now. If you can raise cash or you have cash, now's a good time to deploy it. And number 3 is the loan assumption.
Yeah, those are awesome ways to do deals. And I think it's going to be different. It's not about doing deals, about how to do the deals and about how you can find the sellers that are comfortable with seller financing. I think that's going to be a challenge as well. But with people with the loan assumption coming up, that is something that is a lot of people don't even know is possible. Right. That if you take out a loan, certain lenders allow you to give that loan with the existing terms to a new person.
That's right. Yeah, I'm actually doing a loan assumption right now where I'm staying on the loan, right? It's a local bank. So this is a little bit outside the box, but to do deals right now, like you said, you got to get creative. So I had a group approach me. They're like, hey, we'd love to buy these assets. We love your basis, but we need the loan. And so I called the bank and they're like, you know what, Terrance, if you stay on the loan and in the deal, personally, we'll let them assume the loan, right? So loan assumptions are key. It can give buyers and sellers a lot of flexibility and optionality. Mm-hmm. And what you need in a tough environment is options. Multiple options and multiple buckets of ways to do deals. So, I think that's really, really interesting. I think there's 2 things coming up in the market. They're going to be super interesting that people should watch for, right? That's going to create opportunity, right? If you're sitting there wondering, how do I find the opportunity? Everyone's saying there's distress. Everyone's saying there's pain. How do I find the opportunity? I think there's 2 ways right now that I'd be looking for opportunity. And number 1 is expiring loans, right? So let's say you did a 5-year fixed deal in 2018, right? So you bought a deal, let's say for $10 million, and a bank says, Yonah, we're going to give you a 5-year fixed loan, rate. Mm-hmm. Fixed rate, right? So it's fixed for 5 years. So 2018, 19, 20, 21, 22 expires in March of 23, right? And is on a 30-year amortization schedule, right? You probably had some IO in there. There's thousands of those loans out there that were done in 17, 18, and 19 with 3, 4, and 5 year fixed rate. And then you have a balloon.
Mm-hmm.
A balloon just means the balance is due. So you either need to sell it or refinance. Right. And so right now, anyone that's in that position is very, very, very motivated, because for them to go and refinance is going to be painful.
Right.
They're going to be looking at a 2x on their interest rate. And for them to sell right now is going to be painful. So they're going to be highly motivated to figure out a way to get a deal done. Maybe some carry, maybe some assumption. Maybe they're going to take a discount in exchange for selling it before a certain time. Right. So I think looking for people that have expiring debt is key. The second opportunity in this market is going to be rate cap expiration. Right. What is a rate cap?
What is a
right?
rate cap?
What is a
Good
rate cap?
question.
Everyone's asking, what's a rate cap? Right? I just learned about it. The deal we toured, season 2 that you were on, we went and toured this property. When you do a high leverage deal with a debt fund, right? In exchange for getting leverage, the rate is floating. So I didn't get fixed rate. So we have one property in our portfolio, one that was with a debt fund. And typically the debt fund is like 20, 30, 40, 50, $60 million or more in debt, right? In proceeds.
Mm-hmm.
They're going to be high leverage, sometimes over 80% of total cost. But what do you get in exchange for that? The double-edged sword is it's floating. So what the lender requires you to do to protect you and to protect themselves is to buy a rate cap, which is basically a swap, an interest rate swap, which says once the interest rate goes so high above, and in our case, it's 300 basis points above the existing rate, the rate cap triggers, right? So it means there's a ceiling on the debt, right? But those rate caps have a finite period of time, sometimes 12 months, 24, and the most expensive ones were 36. So anyone that did a deal in 2020 or 21, right, the rate cap's expiring in 22, 23, or 24.
So they're going to be forced to sell the deal at that point or refinance?
They're not going to be forced, but they're going to be highly motivated, because when that rate cap expires, what that basically means is there's no ceiling on the debt.
Mm-hmm.
So as the debt and the treasury, and this is typically tied to a 10-year treasury. So as the 10-year treasury continues to rise, their debt rises and there's no ceiling.
Mm-hmm.
So as the Fed continues to raise rates and people continue to sell the treasury because it's going up, right? That interest rate is going to continue to go up. And so that means their monthly debt service goes up. So
Right.
on that one asset we have, on that one asset, when we bought it, the debt service the first month was $150,000. That interest rate's gone up 300 basis points.
Wow.
300 basis points. So now that debt service is $250,000, $60,000 a
Wow.
month, $100,000 in debt service. So that's cash flow. That's distributable cash flow just wiped out, right? And so imagine people that, the rate cap was even further back, right? Now their debt is going to continue to climb,
Mm-hmm.
and they're going to be highly, highly motivated to figure out a way to sell.
Right.
So I think those would be the two opportunities I think that not a lot of people are talking about of, ways to uncover some opportunity.
How do you find deals like that? It's a little bit of a challenging thing to
It's a nuance.
to research.
It's a nuance, right?
Who's taking out loans at what types of loans and when they're due.
Yeah, that's a great point. So how to find that, right? So you can go on CoStar, right? CoStar should have some info on debt,
Right.
but the other people are like the CBREs, the JLLs of the world, right? Any major shop that originates debt, they're going to have the entire book of their clients and deals they originated and what's going on. They're going to have all the info on the rate cap and on when the balloon is due and when that fixed rate mortgage expires. So two things to be watching for: the fixed rate, when does that expire,
Yep.
right? And then two is the rate cap, when does that expire? And so talking to any major lender, they're going to have the book on, hey, this, and this, and they're going to be trying to get the refi as well. So you're going to be, there's a lot of people there competing for that, but I think that's where to uncover some value in 2023, right? So when people ask you, hey, Yonah, where's the opportunity? Now you know.
Now I know.
Now you know. That's where the opportunity is.
So Terrance, what would you say has changed from the way you were doing deals before until doing deals now? Meaning, what should you not be doing?
Yeah, this is something I talked to my team a lot about, right? 90 days ago, I had over $1 million non-refundable on a deal, and I got retraded by banks 3 times.
Wow.
Interest rates went up 150 basis points. So that's a very uncomfortable place to be when you have $1 million non-refundable and the debt's going up 150 basis points, and you're like, hey, I can't do this deal anymore, right? The only way to do the deal is for the seller to give you a concession. So, basically I had no control. So that taught me a lot, right? So the last 90, 120 days, I've learned a lot about ways to structure deals that necessarily did not work before, right? So if you think about 2020 and 21, right? Just the economic environment we were in, cash was everywhere. Deals were everywhere. So many buyers chasing a small number of deals. So what did you have to do? You had to get very aggressive on your time and on your non-refundable earnest money, right? So every single day, deals were worth more, right? Because rents were going up and debt was going down. So you wanted to tie that deal up as quickly as possible and own it to capture that value, right? So in the past, we were trying to close very quickly, really short DD, and go non-refundable extremely quickly. So today, it's the opposite. Today, I want as much time, right? As much time for due diligence. I want multiple outs for financing. I want a financing contingency, right? I want multiple extensions, right? I want to be able to extend 30, 60, even 90 days. I want multiple outs because every single day, rents are maybe stable or stagnant or potentially going down now, we're going to see. So stay tuned. Rents are going to start coming down and debt's going up. So every day the deal's worth less.
Wow.
Every day the deal's worth less, which we haven't said in 10, 11 years. But that's literally the truth. Every day the deal's worth less. That doesn't mean I don't like the real estate long term. It just means that in the eye of the beholder, I'm going to have less cash flow.
Right now.
So naturally I can pay less. Right? So that means the deal is actually worth less on a fair market value. And so the things to do is to take more time to draw it out. Don't go non-refundable until the very last day or as long as you can. Right. So the keys to structuring contracts now are much different. You want to give yourself much more time, much more bandwidth to make decisions because banks and financing is very volatile. It's changing. Every 30 days, banks are repricing.
Yeah.
And so you cannot go into a deal and think that, you're going to get the terms that the bank gave you 30 days ago. They are 100% going to retrade you before you close. And so you want to give yourself as many outs as possible.
Yeah. Awesome.
So 2022 is a big year, Yonah. I've had so many people telling me that this is the last year for 100% bonus depreciation. And so I've been waiting to see you in person so we can unpack this because this is a big deal, right? So help me understand why 2022 is such a pivotal year for cost seg.
So this 100% bonus depreciation rule was set into play back in 2017 and had a finite deadline, which means this year is the last year you can take 100% bonus depreciation. Next year, 2023, it's going to start going down by 20% a year, which means the bonus depreciation, the accelerated depreciation amounts you get once you do a cost segregation study, you can take upfront. And this has been a huge game changer for a lot of people the past several years, right? People have been doing deals just to get this 100% bonus depreciation.
Well, I'm one of them. I mean, the bonus depreciation has changed my life.
Yeah. I mean, it's crazy the amount of deals that have been done specifically because of this factor. Now, I often like to say, don't let the tax tail wag the dog, right? But if that is going to be a really extremely important factor in your deal and in the return, then it can make a big difference. So this year, 2022, is the last year you can take 100% bonus depreciation. That means not by the end of December 31st, but it just means you have to either buy a property, place it in service before December 31st, or have a property that you bought in the past several years that you're filing your 2022 taxes for. This can be done in 2023, right? You can file your taxes on extension and have until September, October 2023, but this is the last year.
Well, you have to have purchased it either 2018, 19, 21, or 22, right? So you have to have bought a property in the year, so prior to December 31st.
Correct.
And then you can still qualify for the 100% bonus depreciation. Any property bought in 2023, you're going to get 80% of, and then that final 20%, what gets distributed over the next 20 years, or how does that work? So
cost segregation, the way it works is we're breaking down the building into 27.5-year property, right? Which is spread out over that long period of time, 15-year and 5-year.
Got it.
That 5 and 15-year, you could take that lump sum of bonus depreciation 100%. Next year, you can only take 80% of those deductions. The remaining 20% can still be spread over that 5 and 15-year schedule.
Got it. Okay, so you can spread it. So if it's a 5-year property, you can spread it to 20% over 5 years. If it's a 15-year property, then you spread it over 15 years.
Correct.
Got it. So it's based on what the product is, what the material is.
What is in the property that we're accelerating.
Super interesting.
And then it's going to start going down from there, phasing out by 20% each year.
So 2023 will be 80, 24 will be 60,
40, 20, and then no more bonus depreciation.
So in 2026, no more bonus depreciation. Is that the last year?
I think 27, if my
27,
right.
Got it. Yeah. You can do the math there at home. You can figure that out. Yeah. Got it. Interesting. So there's a finite shot clock on bonus depreciation.
Yeah. Now, all you listeners out there, if you want to go and speak to your local representatives and try to get them to extend that and put in that they should keep this in the law, I think it would do everyone a favor. A lot of good. Wow, super interesting. Now, I want to ask you, what's your number one tip for getting deals done in this type of market?
The number one tip I would say right now, right? And I'm very big into education, right? So I'm always thinking, what would I do, right? What would I do in this market is get a mentor, right? I think being able to have someone open the door, stand on their shoulders, and be able to accelerate your journey to take advantage of this moment in time, right? And the story for me is, in 2008, the Great Recession, prices will most likely never be as cheap as they were, right? If you look out the door here in Denver, you could have bought every house on this block for $50,000 or $60,000. Now every house is $700,000 or $800,000, right? So, but what did I had? I had really good people around me. So we bought some houses, but we were doing flips. Had I had the right mentor, that would have said, hey, Terrance, you don't know how to buy them. That's the hardest part, right? There's deals everywhere. Cash was very hard back then.
Right.
You don't know how to buy them. Let me show you how to build real wealth, which is hold them, grow your balance sheet. That's how you build wealth, not on transactions, right? But I didn't know that. I did not know that that's how you build wealth. I thought building wealth was, you flip 100 houses, you make $20,000 a house, blah, blah, blah. I made $2 million. That's wealth. No. After taxes and partnership splits, you end up with very little of that, right? But the true wealth is built on buying, holding, refinancing, tax-free event, refinance again, rents go up, debt was going down. That was the way to build wealth, right? But I didn't know. I didn't have the right mentor. And so going into this downturn and this season of economic volatility and uncertainty, right? And if you look at any of the headlines, right? Blackstone, Goldman Sachs, JP Morgan, every major institution is saying we're going into an economic winter, and use any adjective you want there, right? They say it's going to be really bad. Jeff Bezos, everybody's saying how bad it's going to be, right? And so that's the time to be getting your things together, ready to make a move. And the first move you should make is get a mentor that's been through a downturn before that can guide you to change your life. Because if you get the right person that opens the right door, gives you the right tip, and the right light bulb goes off, it can change your life.
For sure.
Change your life.
I mean, getting a multifamily mentor, that sounds like a great name for a podcast.
That's right. Maybe we should think about that. We should talk about that after. So I'm really big into mentorship, right? I'm really big into education. I think that's the number one thing I'd be doing. And, you recently joined a program that's coaching, right? And you've been known as the cost seg king. That's how I know you. That's how most people know you, right? And so you joined a mastermind that's around capital raising, right? So talk maybe a little bit about why you made that decision.
I absolutely agree. Education is key, and having a mentor is something that I've interviewed hundreds of people on my podcast and everyone says having a mentor was the biggest factor that changed their trajectory in their business. Almost everyone to a key. And so I knew that, cost segregation is a great business. We're doing amazing things. I love it. But through the network that I've built and through the past several years, I've done a lot of investing as well. Mostly passively investing as a limited partner, but I've come to learn a tremendous amount about how to invest in real estate. And I've done some deals on my own, but I really feel the power of leveraging your network and leveraging, other people's capital, other people's money in order to do deals. So I joined this mentorship, Raise Masters, led by Hunter Thompson. An amazing
shout out season 1, Hunter Thompson, my boy.
Amazing group of people, and there's a lot of training, a lot of one-on-one, a lot of group, a lot of amazing people coming together to learn how to invest, not just invest in real estate, but how to raise capital.
Wow, amazing. So even you, and I think this is really powerful, even you with the network and the track record and your credibility, your brand name in the market, you're looking to grow and expand, right? What you can do and what you can offer to the market, right? And to, maybe get one more class of deep knowledge, specific knowledge, right? And so it on accounting, the CPA, and the cost seg side, right? The depreciation side. And now you're going to go get it on building relationships, doing deals, raising capital, right? And I think that's amazing. A true testament, right? You're known as the best at what you do, and you're now wanting to expand and grow. And I think that's a lesson for everyone out there, right? Even the best of the best is looking to expand and grow, and he's using mentorship to do it. Mentorship. Beautiful.
So what about mentorship? Is there some way that people can reach out to you to be a mentor?
Yeah. So, throughout the years of the show, this is season 3, a lot of people have reached out and said, hey, can you show me how to do deals, underwrite deals, meet with brokers, raise capital, all the things, right? We've, bought over $200 million in real estate the last 2 years, and we've had an epic run, amazing team. I think just could do an entire series on just hiring and training people, right? I mean, that's probably the hardest thing that we do here. And so, this last year we did put together a group, right? A small coaching group, and we're working with individuals that want to really raise their level of play, take their game to the next level. And we're calling it the Value Tribe, right? The name of my company is Value Add Real Estate. And so the Value Tribe is just all things real estate, people that are flipping, wholesaling, multifamily, even, other things, raising capital and helping them grow and expand, right? Get deep knowledge, specific knowledge based on, mine and some other people that are leading the group of what we've done and the things that we've learned, right? Because we've made mistakes and done things that we can help accelerate and give kind of people a shortcut in terms of getting and reaching their potential. So, education, I'm super passionate about it, and it really fulfills me, brings me a lot of joy to be able to connect with people that are highly motivated and want to take their game to the next level.
Yeah. I think that's the best part about having a mentor is that you don't have to make the same mistakes that they made.
Right.
You can leverage their experience.
Learn from them. Yeah. And I think networking, right?
Mm-hmm.
Getting around other highly motivated people. It's like you're only as good as the people you're around, right? And so if you're in a market or you're in a place where maybe you don't feel motivated, you feel stuck, you're maybe scared, you have maybe the wrong mindset, getting around a different group of people is life-changing, right? And so getting around a group of people that are highly motivated, that all kind of have a similar motivation and passion for growing and learning and things that they're going to accomplish, I think is really contagious. And I think, that's what you talked about too, is like 100%. The group of people you're around is maybe the most attractive thing, right? And so I think getting around the right groups of people can really be life-changing.
Awesome.
So Yonah, thank you for being on season 2, being the most watched show on season 2. Thank you for hosting. I thought you did an incredible job. You got the late night DJ voice.
Oh yeah, we're going to wrap it up.
So how can people find you?
You can find me on all the social media, Yonah Weiss. I think there's only one of me. And go to yonahweiss.com if you want to learn more about what we're doing.
Love it. So if you enjoyed this episode and you enjoyed what we're doing,
make sure to like, subscribe, and share this podcast with everyone.
With everybody. So much value packed into 15, 20 minutes. Share it with people that you care about.